Okay, well, we'll go ahead and get started. My name is Alex Oliver. I'm a financial advisor with First National Corporation. This is part of our financial boot camp series that we do with Schwartz & Schwartz accountants every year. This is the second in our series. We'll be going over health savings accounts, which I'm sure most of you at least have heard of, but I want to make sure I cover this account in detail because it's being offered and used much more in recent years through employer plans. And it's definitely an account that I use as part of the financial plans that I write for my clients where relevant. And I think it is actually more relevant than most people think. I'll go through some of the default options that people have handled their health insurance and how we've gotten to where we are today, and why I think health and savings accounts are, going to be a big part of most people's financial plans as we go along here. So again, just to give you a little introduction, if you see my webinars, you know already that, again, I'm from First National Corporation. We are what's called a registered investment advisor down on the South Shore in Rockland, Massachusetts. Registered investment advisor means that we're a completely independent company. So while we might custody wealth management assets at Schwab and Fidelity, or manage 401k plans at Fidelity or MassMutual or John Hancock, we're completely independent of those companies. We get hired as a legal definition of a fiduciary, meaning that we are learning about our clients' situations and acting in their best interests, whether that's through a provider for their 401k plan for the small business, or whether that's through a financial plan having to do with income tax strategies, investment strategies, estate planning, insurance, things of that nature. Again, our goal here is to be the financial planner for our clients. And enact a financial plan that makes sense for them and their situation. So we work with about $750 million in assets these days, about $450 on the wealth management side, and $300 on the 401k side across 50 retirement plans. As I mentioned, this is our second installment of the Financial Bootcamp series. Last month, we did a Stock Markets in 2020, What to Expect webinar, and that went over my thoughts of going over several different financial metrics. 1 month ago, we were on the early stages of the coronavirus, and so things have certainly changed since then, but it seems like we might be on the back end of that now, so I think that webinar is still very relevant as a macro view, looking at 2019 going into 2020. Again, today we're doing health savings accounts. Next month, we'll be doing a series of retirement plans, so if you're a small business owner, one of our niches here at First National Corporation is to work with small business owners in implementing retirement plans for their practices. Typically, simple IRAs, 401ks, profit sharing plans, and cash balance plans all have their pros and cons, all have their associated costs. So feel free to tune into that if you are a small business owner. And then our last webinar, which will happen in April, How to FIRE Part 2. FIRE is an acronym that has come up that stands for Becoming Financially Independent and Retiring Early. Part 1 of this was in the fall, going over the accumulation stage into requiring the amount of assets you need to retire early. Part 2 will be distribution strategies. A lot of things to think about when you're retiring at 45 or 50 years old and might have 40 or 50 years of retirement, Social Security way down the road. So I'm going to be going over some of those things, a lot of income tax talk in that webinar. So I encourage you to tune into that. Part 1 was actually our most popular webinar last year. So hopefully we can keep it up with Part 2. If you want to go register for those, schwartzaccountants.com/events/bootcamp. Or if you want to see some of our past recordings, they are all also located on that same page, schwartzaccountants.com/events/bootcamp. We've been doing this for a couple of years now, so we've definitely got a good little library going on here. I've mentioned a couple of these already, but student loans, if you're a W-2 employee and you want to know more about your 401k, I can tell you about that here. Legacy planning, wealth transfer, a little bit of intro on the stock market, Social Security. You can see the list here. We really try to cover a lot of array of activities, so that way you can be a more informed consumer, whether that means enacting your financial plan on your own, or maybe realizing that there's actually a lot to all these areas that you maybe want to have a financial advisor help you out with. So either way, we're going to give you the information and you can digest it and do with it what you like. But as always, I want to make sure I give a disclosure here to consult your own advisor or do your own due diligence on anything that we talk about today. There's a lot of topics even around health savings accounts that are still ever evolving. Laws change. Even in December, laws have changed that change up financial plans. So certainly don't want to act like I'm giving advice here in any way, shape, or form without knowing your situation. So be sure to do your own research and conduct your own due diligence before enacting health savings accounts or doing anything we talk about today. So just to give you a little bit of background on health savings accounts, again, why we're here. Back in 2003, under the Bush administration, we actually got HSAs created, and so I would actually call that a relatively new account, being in the last 20 years or so. Back then, contributions were only $1,000 per year, and they have slowly crept up. Those are still relatively low contribution limits on HSAs, but they are becoming much more popular, especially because of the 2010 Affordable Care Act, or Obamacare, where now we have these healthcare exchanges, and particularly important for small business owners where maybe having a full-fledged health benefits program was a little out of reach. And so instead, either you're self-employed and going to an exchange, or you're enacting these health insurance policies through the exchange. And now we're giving a little bit more control to the employer and the employee for what kinds of plans they have. So if you're trying to keep costs down, and maybe you're a generally healthy person, you might use what's called a high deductible health plan. We're going to abbreviate that through the presentation here, HDHP, high deductible health plan. Very important, because the high deductible is what qualifies you to be able to use a health savings account. So, and essentially the government has said, if you're willing to take that on yourself, the kind of general idea, again, as how we've gotten here, maybe 20 or 30 years ago, your parents may have had pensions from their employers. They may have had just these fantastic benefits packages, but now we're living longer, healthcare costs more. We're trying to put those costs back onto the consumer. And so because of that, we're giving them the option from the government's perspective to use a high deductible health plan and then get this nice benefit of using the HSA. And so again, I think from 2010 on, we've seen the adoption of these plans grow quite steadily. Certainly in employers with 5,000 employees or more, it's a very commonplace. Those people will certainly know a lot about HSAs, but most people in the United States work for a smaller employer, and so they may not know a whole lot about HSAs or even know that it's an option. So again, my job today to make you more aware of that and why it's such a big deal. Okay. Again, going back to the history of how we've gotten here, typically I would say, and even talking with clients today, once you start a family and you're thinking about health insurance and your health expenses, I think the default mindset is to just go with the most expensive plan, which in general cases might be a PPO, and try to keep your costs down, keep your deductibles very low. But again, as you've seen, high deductible health plans have come a long way and are starting to get an adoption rate second to PPOs. Just to give you some comparison with a PPO and an HDHP, the annual deductible on a PPO in the United States average is about $2,200, whereas a high deductible health plan, your deductible, which would be your out-of-pocket expense before the insurance really kicks in, is about $4,300. So, when you sign up for an HDHP, you might have a smaller premium on a monthly basis, but if you need to consume healthcare, you got to come up with that extra $2,200. But then, interestingly, the out-of-pocket maximums in the United States are actually relatively the same. So PPOs, your out-of-pocket maximum around $7,400, HDHP about $8,400. So when you have these really big emergency, big situations, they're actually not that big of a difference, okay? And diving into that further, again, we've talked about the cost of healthcare increasing substantially, 7.4% since 2018 to 2001, while overall inflation is only 2%. So this is a big deal for, I think, most of the people in this webinar who are working today, assuming you're still accumulating assets, but a really big deal for people who are 65 and older and maybe thinking about their Medicare options or their long-term care options if they have to go into a nursing home or hire a home health aide. We're going to get into how health savings accounts help with that. But I think really, what we want to try and look at the HSA as is maybe we'll look at it as a 401k plan, as I'm going to, again, talk about in this webinar. But this also may just be literally our healthcare bucket as we go along in our life and as we retire. This might literally be something that we can consume because of these high costs, okay? So really important things to keep in mind. There's a lot of acronyms in this space, HMOs, HRAs, FSAs. So we want to make sure we don't confuse any of these. Again, HSAs, health savings accounts, important that you check to make sure that, again, you have a high deductible health plan with an HSA. That's typically going to be the arrangement that I might recommend, again, for a lot of my clients, but we'll talk a little bit more about that. So let's again start with a high level look here. This is a little chart that I show my clients pretty frequently. And notwithstanding what an individual financial plan might call for, if we just have extra money and let's say we've already bought our house, we've got our emergency fund ready to go, and we're just trying to find places to put money, this might be the general set of recommendations that I would encourage a client of mine to use to ensure that they can mitigate their tax consequences. So first of all, at the top of this bucket, 401k match, that's your best bang for your buck that you're going to get in any strategy I can recommend. So if you need to contribute 3% to get a 3% match, that's a 100% rate of return on your money. If you need to contribute 6% to get a 3% match, that's a 50% rate of return on your money. So no matter what, I'm sure everybody in this phone call, if they are working for an employer as a W-2 employee, they're already contributing to 401k to get their match. Next, I would stop the 401k and then tackle high interest debt. Any credit cards that are over 10%, we certainly want to get rid of. That's a whole other set of issues. But again, I'm sure most of the attendees here are not in that issue. But importantly here, next comes health savings accounts. We're going to get into the triple tax benefits as we go along here. But note that HSAs come before 401ks. So I wouldn't go above the match until we've maxed out the health savings account, which will be a different number, whether it's an individual plan or a family plan. Again, we'll get to that, but just keep this in mind that it's 401k, high interest debt, health savings accounts. Then we try to go back to the 401k and defer taxes into the 401k. The maximum for an under 50-year-old is $19,500. So if you're doing these things already, as an individual, you're putting around 22 grand in, 23 grand. As a family, that's around 28 or 29 grand. If you could do that, next would be backdoor Roth IRAs. I talk about those in my other webinars, so I won't talk about that today. Then taxable accounts, then low interest debt. So a common question I might get is, should I be putting extra money toward my mortgage? Today in 2020, usually the answer to that is going to be no, because you can probably refinance that and get an interest rate at 3 or 4%, whereas all the tax benefits that you get with these accounts far outweigh paying off low interest debt. So that goes to the bottom of the list here, okay? So again, as this presentation goes along, keep in mind HSAs here, number 3 on the list, a really important account for me. I want to make sure I also review the tax benefits from a pre-tax perspective before we go too far here, because again, sometimes I might get some questions. Should I be making pre-tax contributions to my 401k or Roth contributions to my 401k? The HSA is making a pre-tax contribution, so you're putting money in before you pay income taxes. And so for a high income couple, avoiding income taxes today is crucial, is super important. And I just want to go through a quick example to make sure we understand exactly how crucial this is, because again, I see this get missed all the time, and the consequences to this pre-tax 401k are the exact same as the HSA. So let's just go through a married couple living in Massachusetts, earning around 350 grand. They defer money on a pre-tax basis. So that person, I chose 350 because that goes into the 32% federal bracket. The next one down from that is 24. The next one down from that is 22. So use your own numbers here to get an idea, but the more money you make, the more important the HSA is. You're avoiding federal income taxes at 32%. You're also avoiding state of Massachusetts income taxes at 5%. So as a combined number, you're avoiding 37% of income taxes, okay? When you retire, 65, 70 years old, whenever you have zero income, you're gonna start pulling this money out at the income taxes of that time, which certainly could change, but also based on your income at that time. And so if a retiree was pulling out assets today, they would be getting the standard deduction, $24,800, that they would pull out at a 0% rate. Okay, so they wouldn't be paying any taxes on that number of assets. The next $19,750 comes out at 10%, and then the next $60,500 comes out at 12%. So in essence, what they're doing here is they're pulling out a little over $100,000, and they're going to pay $9,235 in taxes for an effective tax rate of 8.79%, and that's if they live in a no income tax state. If you live in an income tax state, again, such as Massachusetts, just add 5% to this number, and they're going to pay about 13% on those withdrawals. So again, the point here is you're avoiding income taxes at 37. You're going to pay 8 or 9, or call it 13, roughly. That's a big savings, over 20% savings just on income taxes, where we haven't even talked about investments yet. And so that's why a 401k has, traditionally been really pushed as a really important tool for saving for retirement or just building wealth in general, because it's very hard to get an investment return of 20%. You're already doing that just through what we call tax arbitrage, manipulating your income tax brackets, plus whatever investment returns you get in the account. So, really good bang for your buck on the 401k. Same thing with the HSA. Money goes in pre-tax. You avoid income taxes. You'll take it out later if you don't use it at a very low income tax rate. Again, we'll get into more detail with that as we go along here. So now that I've set the table, let's just make sure we talk about HSAs for anybody that either hasn't heard about the account or doesn't know the details around them. So to be eligible for an HSA, you have to have what's called a high deductible health plan. I certainly see many people that aren't quite familiar with what a high deductible health plan is, but there's a definition for it. If you're an individual tax filer, your deductible has to be at least $1,400. If you're on a family plan, your deductible has to be at least $2,800, okay? So any number of that and above, you now qualify, you are designated as an HSA, or excuse me, a high deductible health plan, and you can use an HSA. The other factor here is that your total yearly out-of-pocket expenses cannot be more than $6,900 for an individual and $13,800 for a family. So if you have a deductible as a family of $4,000, you check this box, but let's say your out-of-pocket max is $15,000 as a family, you don't check this box and you're not eligible, okay? So just make sure you read the details of your plan. Obviously, if you're at a large employer, your administrator should be able to help you with that. So we say that HSAs are triple tax-free. So what the heck does that mean? Well, we've talked about contributions being tax deductible. So $3,550 for an individual, $7,100 for a family. So again, if I make $100,000 and I defer $7,000 into the plan, when I get my W-2 or show income to the government, it's like I made $93,000. I didn't have that other $7,000 of income because I deferred it into the HSA. Okay, so that's step number one. Step number two is that the assets within the HSA, they grow tax-free. So you're not paying what are called capital gains taxes. You're not paying taxes on any dividends that are distributed within the account because it's within this tax-efficient bubble. If you had a taxable account at Schwab or Fidelity or Vanguard, you'd have to pay taxes on that every year, as I'm sure you're aware, when you go to see your CPA and they're helping you to avoid those taxes. The HSAs avoid all of that. And then the third step here, funds can be withdrawn without being taxed if they're used for medical purposes. So for people who do have HSAs, what they're likely doing, or what they maybe have been doing in the past, is just if they put $500 in and they get a medical expense, they just take the money out and it's like it's being paid with pre-tax money. What I'm going to allude to here as we go along here is that you don't have to take that money out. You can leave it in there, but then you can take it out tax-free later as long as you keep your receipts accredited. So that goes down here to unused funds are yours to keep. This is not to be confused with a flexible spending account. Again, I see clients that are very familiar with FSAs. I put $1,000 in, but if I don't use it, I lose it. That is not how an HSA works. If I put $1,000 in and I consume no health care, I still have $1,000 next year, and I can use it at any time for any out-of-pocket expense, okay? These funds can be used for retirement at age 65 as compared to 401k plans where you can actually start taking it out penalty-free for age 59 and a half. So just a little detail there to keep that in mind if, again, you're trying to go for early retirement. And again, like the 401k, withdrawals are taxed based on your income tax bracket during retirement, which inevitably is likely going to be a lower income tax bracket for most people. Okay, so I hope that gives you an idea. It's just some of the basics on HSAs. HSAs are relatively flexible for what you can use them for and what is considered a medical expense. So I've included a little website here just to give you an idea. It's a nice long list of expenses that are eligible for use from an HSA. Feel free to use that or just Google HSA eligible expenses. But I've included a few items here to give you an idea as to how flexible this may be. Generally speaking, obviously things like cosmetic surgery, things that are not necessary necessarily, they're not going to be included for HSAs, but long-term care expenses like nursing homes and home health aides, long-term care insurance premiums, they also can be used with HSA dollars. There is an age-based limit on those, so you'd want to look that up just to be sure you're not over-claiming there. Co-pays, deductibles under Medicare, Medicare Part B and D premiums, though not Medigap supplemental insurance premiums, just a little side note there. And then all these other random items, ambulances, eye exams, vaccines, x-rays, psychological or psychiatric care are all going to be included. Feel free to, again, Google this with your own set of health circumstances to see what kind of expenses you might be able to use for the HSA. But now I want to start to really get into the meat and potatoes of this, because I've gone through so many analysis with my clients to see whether the HSA makes sense. And 3 or 4 years ago, I really stayed high level because I really didn't want to give too much health advice. I mean, everybody has their own set of circumstances. Again, they're going to go to the doctor for certain things. So I would sort of deflect the conversation to say, well, get an estimate on how much you're going to spend, see what your different plans cover and what they don't. But as time has gone on and as I've started to get into these numbers, I've actually found that PPOs, or maybe your most expensive plan, whatever it's called, might actually be prohibitively expensive. And even if you used all of your out-of-pocket maximum for your out-of-pocket expenses, you might still want to use a high deductible health plan, again, based on the tax benefits and just based on the cost structure. So bear with me here as I go through this example. We got an HDHP over here and a PPO. The HDHP has a deductible of $3,000 versus $1,000 for the PPO. We're going to use co-insurance of 20% and 10%. Co-insurance is a percentage of the out-of-pocket expense that you would pay until you hit your out-of-pocket maximum. So again, you're going to pay a higher percentage under a high deductible health plan than you would a PPO. The out-of-pocket max on this one, $10,000 versus $4,000. We got the annual premiums lower for the high deductible health plan versus the PPO. And then a lot of employers are now making matching contributions. They're putting in, $500 or $1,000 to the HSA. So we got to account for that. We're not getting that on the PPO side. So this just runs through a $10,000 expense. We're going to hit the out-of-pocket maximum on the HDHP, and we're going to see where we end up. So again, the deductible being paid here. We're paying the medical expenses above the deductible all the way up to 10 grand. We've got the co-insurance here that is reflected, and then again, our annual premiums. So you add these up, subtract the employer contribution, and in this case, with these set of circumstances, we've got a net cost to you, the consumer, of $6,500 under the high deductible health plan and $7,300 on the PPO. So right there, you can see, again, even if I consume all the health care necessary, I'm going to be better off in the high deductible health plan category. Even if you took this employer contribution, maybe your employer doesn't give you a contribution. Now we're at $7,500. So yes, if you use all of the expenses available to you, you're going to pay more than the PPO. But hopefully over time, you won't use all of the out-of-pocket max in every given year. Maybe just 1 year every now and then when you have an emergency. Again, that's where I have to say, go back to your situation. But just run the numbers and see what it looks like. Because if you consume no health care, you're going to be way better off with a high deductible health plan, having a lower annual premium, and then we'll get to the tax benefits again as we go along here. Okay? Because in this case, the family is going to contribute $6,100. They can only contribute $6,100 because their employer gave them $1,000, so that limits their contribution. But again, they're going to avoid 37% in taxes. That's going to save them right around $2,200. So my example here already had it cheaper. Now take off the $2,200 in taxes, and now it's significantly cheaper than the PPO. Okay, so run the numbers, make sure it's a situation that makes sense for you. I'm going to just show you a quick example of a plan that one of my clients sent to me, and just phenomenal to look at because this is a large hospital here in the Boston area, and you can see the HDHP, which is with an HSA, has lower premiums versus what they call the classic plan over there. The classic plan has a lower deductible. In this case, we'll go with the family numbers. Lower deductible by about $2,000, but then this is based on employees. The out-of-pocket maximum also just slightly lower, I should say, $900 versus the $5,400. So again, for a client like that, I mean, this client that I'm thinking of, has 3 kids, so they're certainly consuming healthcare. But once we went through the numbers and outlined worst case scenarios, the tax savings and the lower premiums far outweighed using the classic plan over here. Okay, so really something to keep in mind whenever your open enrollment comes up. Okay, and so what I want to really start to get into now is in a more financial planning standpoint, because the HSA, again, you want to make sure you do that analysis for 2020 or 2021 and try to get an idea as to whether this makes sense. But hopefully, in most circumstances, we'll have a situation where we're not consuming that much healthcare, and we're going to have leftover dollars in the HSA from year to year, and they'll carry over from year to year, and they'll be part of our financial plan. Another aspect of HSAs that has really evolved in the last few years is the amount of money that have actually been invested in HSAs. So again, if you go back 5 years ago and even today, a lot of HSAs that I've looked at are just sitting in cash. And the reason they're sitting in cash is because people are using them as a healthcare account and almost like a flexible spending account. They're putting $500 in, but they expect to spend that at some point. So they're not investing it. They're not doing anything with it. It's just sitting there earning 0% interest. There are actually some providers that don't even allow investments in the HSA. So that's a problem. But hopefully, either your employer provides, or you can now go open your own HSA that can be invested. And then again, if you talk to somebody like me, it's going to be like a financial plan. It's going to be a 401k plan where we invest it for that 20 or 30 years, and we end up using it as a retirement account. So that trend has certainly spiked up as time has gone on. Okay, so you'll have to look into the details again in your situation. As I mentioned, some high deductible health plans, they do not have the HSA option attached to them. This is actually similar to my own situation. Small company offers the high deductible health insurance, but it was up to me to go open my own HSA if I wanted to, and I certainly have. So very common for smaller employers to be in that situation. Again, some employers offer the HSA, but they don't allow the funds to be invested. You are not necessarily captive to your employer's HSA. You can go open your own HSA. Check that again with your benefits provider to ensure that that is allowable. But in most cases, you could go open up your own HSA and make sure that the funds are invested if they're not offering you a way to do that. Okay. There's some interesting provisions that once per year, you can actually roll assets out from your company's HSA to your own individual HSA if you want to do it that way as well. And again, you would do that because maybe the investment options at your plan stink, while an independent plan allows you to do what you want to do with it. Okay. Obviously, we're talking about this because we can open up HSAs and invest the funds for our clients, just like we do for a IRA or a Roth IRA or a joint investment account. Very easy for us to set those up. We actually set all of our HSAs up at Fidelity, and then we can use low-cost ETFs and rebalance the account, allowing you to also take your withdrawals when and if you need them. Timely for us to do this. I mean, we always do these webinars around the tax season because if you had a high deductible health plan in 2019, you have until April 15th of 2020 to actually make your contributions if you'd like to, which is really important. That might give you another big tax deduction. I just met with a client yesterday who is actually a classic example of this, that has an HSA and didn't put the whole max into there. Now we might actually get them another tax deduction for their tax filing deadline. Okay. An important note here, an HSA is quote unquote established at the time of your funding it. So that allows the HSA at that point to pay for qualified medical expenses tax-free after that date, and then the funding can occur retroactively. So what do I mean by that? If you're in this situation where you have a high deductible health plan, but maybe you don't have a lot of extra money left over, open the account anyway and just put $50 in there because now it's established. So let's say you do that January 1st, but then you do have an out-of-pocket expense March 1st, okay? The HSA only has $50 in it. You have this $300 visit to the doctor of some sort, and you're wondering how you're going to pay for that. If you can now put money on March 10th, for example. You could put another $300 in there, and now you're able to pay for that with pre-tax money as opposed to money from your checking account. So at the very least, if you're not sure how much you want to put in there, get something in there so it's established, and you can fund those transactions retroactively. And then finally, just a note here, there's no minimum on contribution amounts on HSAs, okay? But Okay, now we're going to really get into the financial planning. I think where most of you hopefully are going to be geared toward, what I really see missed on HSAs is that when you incur the medical expense, again, you do not have to take the money out of the HSA in order to pay for it. And my recommendation always is if you have enough cash on hand, you want to be paying those out-of-pocket expenses. Let's say you go to the chiropractor and it's $60. You want to pay for that on your credit card or with your checking account. You don't want to use the HSA dollars. You want to leave the HSA dollars in there so that way they can grow tax-free. And what happens at that point is you just log the receipt online with your portal, wherever your HSA is. And so when the time comes, you've got this ongoing log over 20 years of all of your expenses. Again, that money gets to sit there growing tax-free. And then whenever you need it, whether it's 5 years from now, 10 years from now, or whenever you go into retirement, you're able to withdraw that $60 still tax-free, okay? So let's just go through a quick example to make sure we're on the same page. Mark enrolls in the high deductible health plan. He enrolls in the HSA in 2020, making the family contributions of about $7,000 per year. I've started this because this is adjusted for inflation every year. And honestly, there's a lot of legislation going around with HSAs where they're trying to raise these limits. And I think this is, again, going to be a very important account as we go on here. So, but for now, we'll just say $7,000 a year for 25 years. He's deferring 37% in taxes every year. So he gets $175,000 into the account in total. He and his family incur $100,000 in out-of-pocket expenses, but he never withdraws from the HSA to pay them. Instead, he pays them out of pocket and he logs his receipts. The $100,000 is left in the account to be invested for tax-deferred growth. Again, no taxes on capital gains or dividends. 25 years later, Mark he turns 65 and his balance grows to $400,000, which actually is just about a 6% rate of return. So that's very, very reasonable and common. Mark can now draw the $100,000 out tax-free and only pay ordinary income taxes on all that growth, 7 to 10% on an effective tax rate basis. And so, what does this look like from here? Now he's going to go into retirement. And, my most common client is very close to retirement, maybe within 10 years. And we're trying to figure out, exactly where they're going to pull assets from on a very tax efficient basis. And that involves a lot of things. It involves what they're going to take for themselves to live off of. If they're donating to charity, that a certain amount of assets is going to go to charity. If they want to give assets to their children, that's a factor into this as well. So just to give you an example, he's got the HSA, $400,000, 100 of that can be withdrawn tax-free. The IRA has $2 million. All of these are subject to income taxes and eventually required minimum distributions. So that's an important consideration. Roth IRA, $500,000. This might be from his early career or he's done backdoor Roth conversions all his life. So he's got a $500,000 balance. The joint account, $1 million. He's got unrealized gains in here for $400,000, which are subject to capital gains tax. This is an account that very commonly we might use for charitable contributions, so we can avoid that. And then he's going to have Social Security income for $35,000 a year. So if he needs to live off $100,000, he needs an extra $65,000. Where do we pull this from? And again, that's where the financial plan comes into play, because as you saw in an earlier slide, the amount that we pull out dictates what our income tax bracket is going to be. So at $65,000, that's not a whole lot of money. We'll probably be still in a low income tax bracket. We might actually want to use pre-tax accounts like an IRA or like an HSA, which has about $300,000 that are still in that pre-tax bucket. We're always going to keep the HSA open because, again, you're still going to be accumulating out-of-pocket expenses as time goes on, and you won't be able to make any contributions anymore because you don't have an income. So that's a consideration as well. So in that sense, if we are, with a big balance here, we'll certainly want to make some withdrawals, but not too many, so we can still get credit and maybe have a lot of this account be tax-free upon withdrawal. Okay, and so we're heading to home stretch here because now we're getting into some, really high-level, really big legacy questions. HSAs, again, are such a young account. There's very few people that are walking into retirement with $400,000 HSAs. Again, it just hasn't been around long enough to accumulate that amount of money. But again, knowing that there's a trend here to put healthcare expenses back onto your shoulders, I'm telling you that this is going to be a big account for a lot of my young clients. And eventually we're going to have to figure out, what are we using this account for? And so an important thing to understand here is that if you pass away, you get hit by a bus, spouses will inherit the HSA as is, okay? So they can use it for their own medical expenses as well. They own the HSA, all the benefits and balances, all the ongoing logs with that, they will still stay the same. But what now happens is when the second spouse passes away and the money goes to their beneficiaries, say their children, that person is going to have to pay income taxes all in year one at their income tax rate. So, that child could be 40 years old, they could be making their own money, and now they get this massive HSA distribution to them, and they got to pay income taxes at, say, 37%. And so then the whole point of what we were doing all this time now sort of goes away because we didn't plan appropriately for withdrawing that account down. So we are trying to get that balance down. Again, it's a balancing act because we want to have some money there for medical expenses. But again, at death, this is a bad account to have, as opposed to IRAs, which just this past December, the laws changed on that too. You used to be able to stretch out an IRA distribution over the child's lifetime. Now it's going to be done over 10 years, but 10 years is still way better than 1 year, because now we can spread out that tax liability, hopefully keep the child in a low tax bracket. Again, the HSA not going to be able to do that. So, for a young person, not a really relevant topic today, but I just a month ago actually spoke with a client that's closer to retirement now, and I brought up this whole idea that they have to be logging their receipts, their out-of-pocket expenses, and they have not been doing that for years. And we're now getting to the point where we're going to start doing the distributions of those accounts as they enter retirement, and we really want to make sure we mitigate their tax consequences there. So really important, again, at a high level. And again, to answer that question that came in a little earlier, you will want to log receipts. And yes, again, you can keep the money in there and not take it out, let it grow. And then I'm looking at the questions now as somebody asked, what happens to the HSA when you die? The beneficiary will be inheriting that with a taxable distribution, okay? So again, high level, HSAs are a really great account. I really can't emphasize how much I want you to take a look at this. Every health insurance plan is different. So again, you just kind of have to run your own numbers. But more often than not, with my clients, they are just in a high tax bracket. They are going to want to get that tax break, just like they've always enjoyed on their 401k plans. And they may be consuming healthcare, but it may not be enough healthcare expenses to make up for that tax break and their lower premiums on an annual basis. So run the numbers yourself, and you may be surprised if your employer doesn't offer high deductible health plans, something that you're going to want to talk to them about. If they don't offer HSAs, something that you're going to want to look into, or at least think about opening up an account of your own so you can control that. And again, very timely here on February 21st. You still got a couple of months in case you did have a high deductible health plan in 2019. You can still get that deduction on your 2019 tax return. So hopefully you'll leave this and go play around with your TurboTax software or whatnot, get that account opened, and pay a little less income tax along the way. Okay, so hopefully I've covered a lot of the high level ideas here, a lot of other topics we can talk about on HSAs that I just don't think are relevant for now for this introductory webinar. But if you are interested and have some more questions, feel free to get in touch with me. I'll have my contact info here in a second. As a resource, fncadvisor.com is our website. Basically, again, we have 3 buckets here at First National Corporation. Personal wealth management, that's where I spend most of my time with individual families setting up their financial plans, learning about their situation, diving into their employer benefits, and doing this analysis myself to give them a recommendation. Institutional retirement plans, we work with a lot of employers around the Boston area. I specifically work with really small business owners, say 25 employees and under, helping them to set up their 401k, profit sharing, cash balance plans. And then we have chapter portfolio strategies. These are tactical investment models that we've been running here for quite some time now. A lot actually get used in the cash balance plan, so feel free to go there and learn more about those. One little resource I'm going to point you as well, if you happen to be a dentist, click on this tab, or even if you're not a dentist, feel free to click on that tab. I've written a little ebook in here that is free if you want to sign up for it. It comes to you in a PDF and a Kindle format. You just have to go to dentist and then put your name in there to get that emailed to you, and then I'm personally going to email that to you. You'll get a lot of good information here on all the basics of financial planning, accelerated wealth accumulation. If you're not a dentist, there's a couple of chapters in here that won't be relevant. They might be relevant from a business perspective, but they're a little catered toward dentists. But again, the finish line, selling a business, investment strategies, all of that's going to be relevant for 80% of people that sign up for that. So feel free to go to fncadvisor.com/dentist and sign up for that. Otherwise, my contact information I'll leave up here as we conclude. Feel free to go read our blog, which we try to write and post different economic commentary up there. My email, our phone number, and my LinkedIn. Feel free to connect with me, and you'll see me share some articles from time to time. Okay. Well, thanks everybody for joining. I appreciate the time. And again, feel free to contact me if you have any questions about HSAs. See you next time.